Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Monday, February 9th, 2026, and the closing print looked upbeat, but the engine was narrow. Nasdaq led, the S&P 500 followed, and the Dow still managed another record close above 50,000. The big story, AI-linked megacaps pulled the indexes higher, while defensives and earnings losers quietly bled underneath. Now flip to the S&P 500 heatmap. It's bifurcated, bright green, packed into the biggest tech and communication services names, but you've also got a real red wash in consumer staples and healthcare. So the board looks healthy at first glance until you realize how much of it is just a handful of giant blocks doing the work. That heatmap split tells you exactly where the money went, right back into AI infrastructure and megacap growth. Tech and communication services led. Energy held up too. And instead of hiding in classic safety plays, investors sold staples and healthcare. Inside tech, it wasn't uniform. Hardware and infrastructure strength stood out, while SaaS took a hit as people weighed the threat from autonomous AI agents. So here's the tension. Yes, we're in record territory, with the Dow closing above 50,000 again. But participation was narrow, and the market's internal structure looked a lot more complicated than the headline. You had a defensive rotation and earnings-driven dispersion at the same time as an AI-led bid. And all of it sits inside a compressed macro window, with traders bracing for this week's labor and inflation data to potentially reset rate expectations. On the chatter side, two themes kept coming up with no clean, single proof point in the price action. First, the debate that autonomous AI agents could pressure parts of SaaS. That conversation may have nudged positioning, but it's not a confirmed driver for any one move. Second, rate cut timing. Traders kept circling whether this week's data could either greenlight or push back March cut expectations. And in the background, you heard talk about the dollar's decline tied to geopolitical tension and diversification flows, mostly noise today, but definitely still on the radar. Alphabet just made something very clear. AI is no longer just an innovation story. It's a capital structure story. Google is heading back to the bond market, raising $20 billion to fund AI infrastructure, even floating a 100-year bond. Why? Because AI demand isn't just expensive, it's front-loaded. Capital spending this year could hit about $185 billion, more than double last year. And for the first time, Alphabet is openly flagging a risk you rarely hear from big tech: excess capacity, too many data centers, too much leased compute, and liabilities that don't flex if demand slows. That's the real AI trade-off: massive upfront spending to defend future relevance, while your core profit engine, search advertising, faces potential disruption from the very technology you're funding. So far, the math still works. Ads grew about 13.5%, Gemini users surged to roughly 750 million, and the bond deal was about 5 times oversubscribed. But now markets are watching one thing closely: not can Alphabet build AI, but how much balance sheet risk it's willing to carry to stay in the race. Oracle was one of the loudest tells in today's tape. Oracle jumped about 9.6% after an analyst upgrade that said the sell-off had overshot and pointed to better confidence in OpenAI's funding capacity. In a market that was already leaning back into AI, that move reinforced the infrastructure and cloud storyline and helped keep the leadership lane firmly in big tech. Nvidia was right back in the driver's seat. Nvidia rose about 2.5% in an AI-led session, underscoring that hardware and infrastructure were where buyers had the strongest conviction. When Nvidia's acting well, it tends to set the tone for semis and for the Nasdaq's risk appetite overall. Microsoft was another anchor. Microsoft climbed roughly 3.1%, and because it's such a heavy index weight, that move mattered far beyond the single name. Today, that strength was a big reason the S&P 500 could close higher, even with staples and healthcare showing real weakness on the board. On the other side of the tape, Merck showed what was getting sold. Merck dropped about 3.5% as healthcare lagged. That's what made today feel conditional. The indexes were green, but defensive groups weren't catching a safety bid. Capital was moving toward higher beta growth instead. And then you had pure earnings dispersion. Cleveland-Cliffs sank about 16.4% after a revenue miss. That's the under-the-surface reality on days like this. The index can look fine, while individual names are getting repriced hard on company-specific results. Hims & Hers was another outsized mover. Hims fell about 16% after the company pivoted away from popular GLP-1 copycat treatments. Same message as Cleveland-Cliffs. Even on a green day for the indexes, single stock outcomes were extreme, and positioning in higher beta stories came with real downside risk. Looking ahead, macro's back in the driver's seat. The 10-year yield eased to about 4.2%, and attention is locked on Wednesday's delayed January jobs report, which now includes annual benchmark revisions after the partial government shutdown. Alongside that, this week's inflation and labor data are the key checkpoints the market's using to debate whether a March rate cut is plausible, without treating it as a done deal. So that's the day. AI leadership made the close look clean, but defensives were weak, and earnings dispersion was loud. Heading into the next session, the question isn't just whether the indexes stay green, it's whether participation broadens, and whether the macro data disrupts this narrow leadership trade. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.